Good morning. Welcome to Daily Rates Live with the Mortgage Calculator. Today we're going to be going over some live mortgage rates, and then we're going to be talking about 5 to 8 unit property loans. Great topic here, something that we love at the Mortgage Calculator. So we'll get into that here shortly. We'll wait just a minute here to go live on all the different platforms. So please drop a comment there as you tune in. I see the comments already coming in. Definitely appreciate that. And we'll get started here in just a moment. All right. Cool. Looks like we're live on all the different platforms, so we'll go ahead and get started. What we'll do is we're going to take the chat off the screen for now, but keep dropping comments in there and also drop any questions that you have in the chat as we go through the presentation. But we'll go ahead and get it started. All right. So welcome, everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a correspondent lender, and what we do every morning on this show is go through our actual live mortgage rates, and then we do a deep dive into a different loan type. Now, today's loan type is going to be 5 to 8 unit properties. At the Mortgage Calculator, we specialize in non-QM loans and loans for investors. So 5 to 8 unit properties are a very popular product here. So our sales manager, Jose, with 28 years of experience, will take us into a deep dive into that here shortly. But before we do that, we'll do what we do every morning, which is pull up our pricing tool. So Nick, if you're ready, let's go ahead and pull up the pricing and see what the market is looking like this morning.
All right. Let me switch my screen and we will check it out. So as Kyle mentioned, this is our pricing tool. This will show us the general rates for today. It is February 8th, just after 11 a.m. Eastern. So most of our standard programs are live here. So we'll set up a basic scenario and compare the APRs across the program. If you'd like a full breakdown of all the itemized fees that go into the APR, please get with one of our team members. They can send you a full loan estimate that breaks it all down. For the demo, we'll set up a basic loan amount here of $400,000. We'll set an LTV of 80% loan, 20% down payment, and we'll ask the computer to find the lowest rates we can offer for conforming conventional first. Then we'll compare that with our FHA options, which is usually the second best option for most borrowers. And then we'll check out our expanded guidelines, also known as non-QM, where we have over 5,000 options beyond the standard here. We also offer VA. That's only for eligible vets and active service members. If you are, just let us know. We'd be happy to quote it. And USD is only for eligible properties. If you do have me looking in those areas, just let us know. We'll quote you no problem. We'll start with conforming conventional. We'll do a purchase, 30-year fixed loan, primary occupancy, single-family home, 1 unit, state of Florida, county of Miami-Dade. And for all the demos today, we use an estimated credit score of 760 and an estimated debt-to-income ratio here of 40%. So with these settings, let's see what the conventional rates are looking like. Went back up a tad. Yesterday went down a tad. This morning went up a tad. Hopefully it goes back down a little bit as the day moves on. Looks like the best option this morning, 6.375 rate for 2.25 discount points and costs. Puts the final APR at 6.647. Yesterday, I believe it was 6.4 on the episode here. So we're still right in that range, and hopefully we see that move down here as the year goes on. Now, if for any reason our customer doesn't qualify for conventional, usually the next option we want to compare is an FHA option. So we'll set up the same exact scenario, and this time we'll select FHA. Everything will stay identical, so we can compare apples to apples here across the programs. FHA does allow a little more leniency on credit issues, as well as a higher debt-to-income ratio, but we'll keep everything identical so we can compare here. So this went up just a touch to about the same as yesterday, actually. 5.5 rate, 2.375 discount points and costs, puts the final APR at 6.428 here for our FHA options, which is a touch under conventional. So our customers that qualify for both, definitely make sure to check out FHA. Sometimes it might be a touch cheaper. And this APR does include our upfront and yearly mortgage insurance. So our customers that need to use these FHA programs, definitely good options, as they are almost identical to conventional right now. Now, where we love to specialize is if unfortunately our customer doesn't qualify for conventional or FHA. Many other banks or lenders will have to deny that customer, but that's where we love to present our 5,000 additional options here under expanded guidelines. So everything will stay the same, except we'll choose expanded guidelines, and that pops a new option up here for income where we can change our income type. So full doc is what we use for conventional and FHA. That means 2 years of tax returns. So if our customer doesn't qualify with 2 years of tax returns, we'll need to use an alternative here. We have asset-related programs, business bank statement programs. The investor programs are just for investors. We'll talk about that shortly. For investment properties. The personal bank statement 12-month is the most popular. That's the one that we will use for the demo. And we also have RSU, stated income, VOE, 1099, P&L, and no income CDFI. But for the demo, we'll use the 12-month bank statement program, which is the most popular. And that's for our self-employed borrowers. Many times it's our self-employed borrowers when they submit 2 years of tax returns, may have various write-offs and may not qualify at all, or just may need a little extra income. Either way, we can solve the problem. No tax returns at all, just 12 bank statements here to determine a debt-to-income ratio using just their cash in the bank to calculate it rather than their tax returns. So many times our self-employed borrowers qualify for much more income and can therefore get that home they really want. So let's check out the bank statement options this morning. Awesome. As expected, we're seeing some downward momentum here in the non-QM, which is usually about a week behind. So remember, exactly 1 week ago, we saw all the conventional rates drop substantially, and now we're seeing the non-QM react. So we have 3 options in the 6s, which is amazing, and even an option lower than yesterday, 6.75 rate for 2.35 discount points and cost, puts a final APR at 7.145. So conventional and non-QM are getting even closer here as non-QM is going down, and conventional actually went up a little bit from yesterday. So we're within about a half a point now between conventional and non-QM. So amazing options for our customers that need to use those bank statements or alternative income. Awesome options we have here. And there's hundreds of variations. If you scroll down here, notice there's hundreds of options. Some of these at higher rates and costs may allow bankruptcies, foreclosures, other credit issues, and some may allow different ways to calculate the income. So please, with our team, there's hundreds and hundreds of variations here on our non-QM programs. And for our final 2 live pricing demos, we always do live pricing for investment properties. We love to work with investors, new investors, seasoned investors. We have great options. So we'll set up the same scenario, 400,000 loan, 80% loan to value, 20% down payment. And this time we'll ask the computer to find the lowest rates we can offer for conforming conventional. And then we'll compare that to our expanded guideline non-QM options. Remember, government programs, FHA, VA, USDA do not work for investment properties. So we'll stick with these 2 here. Conforming conventional will be our first option. It will be exactly the same as all our other demos. The only thing we've changed here is the occupancy to an investment property. So let's see what conventional is looking like this morning. And has been the case for the last few days here when conventional reacts quickly to the markets and goes up. We have our portfolio option many times comes to the top. So these portfolio options are the same qualifications as conventional loans. However, they're not actually a Fannie Mae or Freddie Mac loan, and therefore they don't have the loan level price adjustments that are very substantial here for investment properties. So we see this option come to the top when the rates get a little bit haywire. So best option here, 6.875 rate, 3.25 discount points of cost, puts a final APR of 7.264 for our portfolio full doc option, which is basically conventional without being Fannie Mae or Freddie Mac. The lowest true conventional is this Freddie Mac option here for 6.99 rate, 3.375 discount points and costs for a final APR of 7.396. So good options here for our customers that qualify, full doc conventional. But with the rates and adjustments here on investment properties, always recommend our investors look at a non-QM option as well. So for the final demo, we'll do investment property again, 80% loan to value again. And this time we'll select our non-QM expanded guideline options. So the first thing we need to select here is our income type. Most popular income type for investment properties and our most popular loan is the DSCR option because it doesn't require any income or employment information from our borrower or documentation on that. Simply use the estimated rental income from the appraisal to determine a DSCR value. Stands for debt service coverage ratio. The estimated rents can cover the expenses, aka the property cash flows. That's a ratio of 1 or higher. If the property does not quite cash flow, we have options for ratios under 1. But for the demo, we always put 1.5 so we can see all the best programs pop up. And finally, a prepayment penalty must be selected on a non-QM investment property. 3 years is standard. That's what we use. There are options for no prepay. That will cost more and limit the programs. There are also options for 5 years, which does save our customers some money, but not all programs allow it. Since 3 years is most common, that's what we use here for the demo, so we can see all the most common options pop up. So let's check out the DSCR. Wow, smoking. So a little bit of a drop here. Now we have 2 options coming in the 6s, which is absolutely amazing. 6.75 rate, our lowest cost option here. Our lowest rate option, sorry, for 3.4 discount points and costs. Puts the final APR at 7.256, actually beating conventional and beating the portfolio full doc option here with the DSCR. I would say 110% of investors that get presented with this will choose this option. It's really a no-brainer. It's cheaper than conventional today. And obviously no income, no employment documentation. You can do 1, 2, 5, 10, 20 loans at a time of these DSCR options. Tons of flexibility. And if we scroll down here, there's hundreds of variations. Some of these at a little bit higher rates and costs may allow things like bankruptcies, foreclosures, other credit issues. Some may allow different ways to calculate the income, like short-term rental income. And some of these options here, obviously a little bit further down probably, do allow unique properties such as our 5 to 8 units, which is today's topic. So let me go ahead and switch my screen here. And we'll get into Jose's topic for today, which is going to be our very unique DSCR product for small commercial properties. Remember, anything over 4 units is a true commercial property. Residential property is 1 to 4 units max. So once we get into 5 to 8, that's a small residential commercial property, right? It's still residential in nature, but it is commercial because of the size of the units. So typically, these would be a true commercial loan. We now have a hybrid DSCR product, just like you see me quote live, except obviously we can't choose unique property types there on the live show. But some of those options you see pop up on the DSCR do allow very unique things, such as the 5 to 8 units and even 5 to 8 units mixed use as well. So Jose, if you're ready to show some live examples, let's check out our 5 to 8 unit options.
Good morning, everybody. Thank you for joining us for Daily Rates Live with the Mortgage Calculator. 5 to 8 units, as well as the 2 to 8 unit mixed use product, is one of my favorite loans to deal with because, as Nick mentioned, it's a captive audience. There really aren't that many conduits out there that are offering this product. We at the Mortgage Calculator do, and this is actually one of our specialty products. Like I mentioned, it's one of the ones that's my favorite to deal with because once the investors find out that we have this product at the amazing rate, loan to value, and cost that we have this product, the buck stops here, right? That's it. The search stops. Now we're just going to fine tune the loan. They're going to be really happy about it. And then they're going to turn on all their friends, all their investors to you as the MLO offering this really cool product. This product is normally only available via true commercial conduits, right? So if you were to go to a true 100% commercial lender with this proposal, right, of this property purchase, they would, first thing they're going to ask you is, okay, what's the address? What's the zip code, right? They're going to pop it into their zip code calculator there, and it's going to tell you, it's going to tell them the demographics, population density, crime rate, and all these things that commercial lenders are able to look at. And then it's either going to be yay or nay based on that. You know, they're interested in looking further into the property if it passes that part of their review. However, with the option that we have, that's not the case, right? This is treated as a DSCR loan the same way as our other DSCR loans are. Obviously, there's not a residential property, so they're going to have a couple of additional considerations in the appraisal. But the main thing to note is they're not going to decline it simply because of the zip code and the population density and the MSA and all those kind of stuff. So it's very exciting that we're able to offer this product, and we're able to offer it up to a 75% loan to value max on purchases and 70% loan to value max on cash out refinances. Now, I will state there has been a little bit of consolidation in the 5 to 8 unit and the 2 to 8 unit mixed use product as far as the conduits out there that are offering it. But the good news is at the mortgage calculator, we still have the lowest rate options, like I mentioned to you, with no zip code considerations. Now, if the property is deemed rural on the appraisal, then that's it. There is no workaround for a rural property with this small multifamily hybrid DSCR program that we have. Hybrid because it's treating it like residential, but it's commercial. So our first option here is for our best case scenario borrower with a 760 plus credit score. And again, maximum 75% LTV. And we're looking at 8.625 with a cost of 1.25 points. Now, there are other options for rates. I only gave this one because I'm only able to give one rate per line in this, how we're setting up this quote. But you can buy it further down, but it's like anywhere from 3/8 to 1/2 of a point cost per 1/8% reduction in the rate. So 8.5 would cost 1.75 or 1.625, depending on the specific rate sheet. But very good option here, 75% with our 760 plus credit. Now, I'm just going to give you different examples here on the purchases, running it down the credit grid so you can have an idea. It's probably what's more important here, as much as important as the rate. So here you'll note 740 to 759, we're still able to do 75% LTV. And what I did here, so we compare apples to apples so you could see the effect that the rate has on the cost. Again, you could just choose a higher rate to keep the cost the same. Here, I'm just showing you the same rate, but what is the cost adjustment for the lower credit score. So in this case, we're 1.625 points for the same 8.625% rate. So our cost increased by 0.375 points due to the lower credit score of 740 to 759. Now our next grid is 720 to 739. Still good credit. We're still able to get 75% LTV. That's the first important consideration of your investor. And the same 8.625% interest rate is now costing 2%. So another 0.375 of a point increase in the cost of 8.625. But most importantly, we're still able to attain 75% loan to value or 25% down payment. Our next grid is 700 to 719, right? And again, great news. We are still able to attain 75% LTV with a credit score as low as 700. And again, keeping apples to apples, 8.625 is now costing us 2.625, an increase of 0.625 due to the score. So now the gap widened, the spread widened between, on the rate for the credit score. So it's 0.625 of a point more expensive to get the 8.625 rate due to the 700 credit score. But great news, we can still attain 75% LTV for your investor. So you must be wondering then, at what point does the LTV drop for this loan? Well, here it is, because now at a 680 to a 699, we're able to attain 70% LTV. Still very amazing, and at the same cost. So our cost remains 2.625 points. Our interest rate remains 8.625%. It's just that now we have an LTV reduction. It decreases to 70% due to the lower score, but that is still very, very good. Remember, this is DSCR. And then our last purchase example before I go into our cash out refi examples is for the minimum credit score for this loan program, 660. So 660 to 679, maximum LTV is 70% still, but 660 is the lowest score that this loan can be originated. And then we do get an increase in the cost at 8.625. You're looking at 3.375 points. However, I do stress that you can choose a higher rate. There are higher rates available and at a lower cost. I just wanted to show the 8.625 cost across the different credit scores, and still 70% LTV. So now let me show you some cash out refi options. Excuse me a second. So here is our cash out. Actually, let me, this one. Okay, yeah. And I wanted to show you here an example, what I was just mentioning of the higher rate that we could choose, right? So just to show you, refresh your memory again. This is 8.625 with a 660 to a 679 credit score, right? 3.375 points. However, like I was mentioning, if we were to accept a higher rate, if the borrower were to say, no, Jose, I don't want to pay to buy down the rate, I'm getting an amazing cash flow on that property, I really would rather prefer to save the $17,719 that is going to cost me to buy the rate down to 8.625. What is the rate at which I don't have to pay a loan discount? And it is 9.75. So again, and let me just go a minute here. The payment here is $4,083 principal and interest, but it costs you 3.375 points or $17,719 to buy down that rate. Whereas here, the customer could decide, I'll pay $500 more a month. Is that what it is? Yeah, roughly. A little bit less, about $430 or something like that. More per month to save $17,000. So, what's the break-even point on that? 400 and, you divide 17 by 430, it's probably 3.5, 4 years, something like that. So if they're going to be in their property longer than that, they would recapture all the cost of the buy down. So that's something to consider as well. So 9.75% would be 0 points in loan discount for the same purchase scenario. So now let's give you some cash out refi options. Now, maximum LTV on the cash out refi is 70%, 70. So our credit is 760 plus is the top tier for the credit. And here, 8.875% costs us only 1 point in loan discount. Now, there are 0 point rates, but I wanted to show the 1 point rate. 8.875%, 70% LTV, cash out, 760 plus credit. Our next example, I'm showing at the minimum credit score that we can still get 70% LTV in the cash out refi, and that's 700 to 719, and we can still attain 70% LTV. And what I did in this example is I kept the cost at 1%, just so you could see the effect on the rate, right? And in this case, same 1% loan discount, the rate increases to 9.25 due to the lower credit score. And our last example, I went to the lowest credit score that was possible for this program. Again, 660. So 660 to 679 is the lowest tier. 65% now becomes your LTV. Once you go below 700, LTV drops to 65. So 680 to 699 would also be 65, just a little bit lower rate, right? So in this case, we have 9.875, the same 1 point cost, and it's now 9.875% at a 65% LTV with a 660 to 679. And again, I do stress this is a DSCR loan product, right? So very convenient here for your investors with multiple properties. So definitely looking forward to helping you all structure your 5 to 8 unit small multifamily loans, as well as your 2 to 8 unit mixed use property loans, which is the sister program of this one. The only difference with that one is that it does allow mixed use, meaning you can have commercial components to the property, but at least 50% of the space has to be residential. And in the mixed use portion that's commercial, they don't allow any like industrial manufacturing or anything like that. It has to be, clean products. Retail, professional office really is what is preferred.
Okay, it looks like we do have one question, which is there a 5% LTV adjustment for foreign nationals on these programs?
I do not believe that this program allows for national borrowers like the regular DSCR programs do. So that is, there is some investor experience that may be required depending which conduit we use. And, this is already a higher risk program than the regular DSCR. So I believe that secondary probably feels that adding an additional layer of risk from a foreign national borrower that, may not have credit is a risk they don't want to take.
Okay, good question. I don't see any others though, so I think we'll wrap it up. Appreciate everybody tuning in. Remember, 11 a.m. Eastern every weekday we do this show where we go through the live rates and then do a deep dive into a different topic. So we'll have a new topic tomorrow. Thank you, everybody. Appreciate the question there too. Thank you, Nick. Thank you, Jose. We'll see you all tomorrow. Looks like one more question here. How crucial is for an investor to have structured business plan, and should one be required?
That's not required. What may be required is investor experience of doing, managing or owning investment properties, but not any type of business plan.
All right. All right. Well, thank you everybody for tuning in. We'll see you tomorrow, 11 a.m. Eastern, for the next episode of Daily Rates Live with the Mortgage Calculator. Have a great day, everyone.
Thanks, everybody.
Thank you, everybody. Have a great